All right, rough week last week. So the Feds held firm. They did. I kind of talked about it a little bit, but the reality of it is they kept rates where they were. We all knew that. We all know they're going to raise rates somewhere around September. Why? Because they want you to go spend money around Santa Claus time. Period. End of story. I said that last year. I was like, look, last year, the only reason why they held off doing anything, or the year before that, come around Christmas time, is they want you to do what? Spend your money. They cannot, they have to get people out spending money. Inflation is caused not because of tariffs, not because of taxes, not because of any other stuff. When you print money or you give money and people save money, the only way that things inflate in value is to get people to go spend more money, which means what? They got to loosen up restrictions on what you can buy. The more money you spend, values go up, costs go, the prices of things go up because there's more money floating around. So, I mean, it's just going to happen, guys. It's unfortunate, but it is what it is. So, how do you combat that? How do you have your money not deflate in value because the cost of goods are inflating, right? You have to invest your money in something that's real, right? For real estate people like myself, we want inflation. I want the cost of goods to go up. I want rents to go up, steel, glass, materials, all that. I want it all to go up. Why? Because inflation is good for real estate people. Period. End of story. Because if you convert your cash that is sitting in a savings account, a bank account, IRA, or any type of retirement plan, 401k IRA, SEP, KEO, whatever. Like if you convert your trash cash into a real asset that goes up, that rides the wave of inflation, the value of your money goes up too. It keeps up and or past inflation. So don't get me started on that, man. I can go long and I love that stuff. But the reality of it is this. You got to invest your money in something that is going to push past this nonsense that we keep watching. Like right now, I think President Trump fired the guy in charge of the job stuff. I'm just keeping it simple. But like that's in a ripple effect. He held off from, I mean, the tariffs and stuff like that. Hold off, put it back on, hold off, put it back on. A lot of negotiations happening. So that what that's doing is that's keeping a lot of big players in the real estate industry off of the playing field, or they're waiting, other than like Blackstone, because they're like, hey, the bottom's already hit. We're going in after. But you and I aren't Blackstone. We're everyday, regular, hardworking business owners that have to invest our money in the right vehicle to protect our capital. That's what I want to talk to you guys about today. So, here's the reason why I think real estate's the best play for you guys. I'm talking about income producing, like we said here. We purchase existing income producing real estate. That's multifamily real estate, commercial grade, great locations, great cities, great assets. Boom, that's the game. That's why you have to invest your money there. And I want to build a case for that. Really, I want to convince you guys. And again, I know I get excited. I talk loud, but I'll calm it down. But, anyways, here's what I wanted to compare that to. Because if you take a look at what is this? This is a 10-year treasury. So we're not going into the treasury today. The 10 years at 4.2. It's going to range around 4.2, 4.5. It's not probably going to ever drop back down to that 1.2 again, unless something crazy happens, but it's not. But if you were to take your money out of the bank, out of there, and you're going to deal in the stock market, it's like real estate's better than the stock market if you're going to make an investment. I'm making the case for real estate is the better asset class, the vehicle that where if you're going to invest your money. One, because you can't control stocks. They go up and down. They're volatile. Today, Tesla's up. Tomorrow, Tesla's bad. I think they're going to talk about how Elon Musk finally got his stock shares. It was some ridiculous compensation package. It's not ridiculous because he's the man. Don't get it twisted. But you can't play that game. You can't time the market. If you're a business owner, let's say you're a doctor, you're a dentist, you have your own practice, you're an engineer, you're overseeing stuff, you're a project manager, you're in the tech industry, whatever. While you're at work 14 hours a day, and then you get off work and you go home and you try to spend time with your wife or your husband or your kids, whatever it is that you do. By the time you get off work, your portfolios went down. And then before you wake up, it may go up a little bit. And then it's going to come down. Like it's ridiculous if you're going to play that game because you can't keep up with that game. So number one, real estate doesn't have these highs and lows and major crazy swings. If you have income coming in from 200, 300, 100 people, 50 people that are tenants, every month on the first through the fifth, they're going to pay their rent. If the stock market went down, they're going to pay their rent. If the stocks go up, they're going to pay their rent. That is just kind of how this game plays out. It is. So real estate is better than the stocks that you're going to be able to put your money in and buy, no matter what Thomas Lee says. Guarantees he has a ton of real estate. Anyways, let's say you leave it in savings in the bank. Let's say while you leave your money in savings in the bank, it is going down in value. period. Since I've been alive, the dollar has lost 86% of its value based on inflation. So that means while your money, as a matter of fact, it lost 25% or 26% of its value just from 2019 20 till now, 5 years. So if you had $1 million in the bank, you lost $250,000 worth of its buying power if you just let it sit there to do nothing because it cannot keep up with inflation. It should literally be illegal. It's a financial discrepancy for any bank, lender, financial advisor to tell you that for you to leave your money in a savings account, that you shouldn't even be able to tell people that you're saving money because you literally cannot save money as long as they continue to print money, or the reverse printing is playing with the market the way that they do based on printing money and or giving more debt out to people or this country, which is a reverse form of inflation to me. All right, so next, bonds. No one really invests in bonds anymore. Your mom, your dad, your grandpa, your grandma, they all invested money in bonds because it's supposed to be government backed. But who trusts the government anymore? Not me. The government can't and will not do what it needs to do for you. One, the government's in debt. Our country is in debt. I want to say it was a ridiculous amount of debt. 37 to 47, it continues to climb, right? Based on the new tariffs, based on the new administration. It's not their fault. It's not their fault. This has been going on for a long time. But if you're betting on the bond market to save you, unless you're PIMCO, where you're actively trading bonds in the market, and I think there are like trillions of dollars worth of bonds as it relates to traders, you ain't going to be able to play that game. So you to be able to invest your money in bonds, that's kind of a dead thing. It doesn't happen anymore that way, but it's there. But if you compare that to income producing real estate, man, it is no comparison. All right. Next, retirement accounts, which I went over. There is $37 trillion in retirement accounts in, I want to say the United States, but it's probably in the world. And I want to say $13 trillion just in IRAs. IRAs alone, but if you combine all retirement accounts combined, it's 37 trillion. That means what? That money is sitting tied to mutual funds, probably stuff you don't even know what it's tied to. 401k, they continue to attribute in. You're probably in 100 things, probably in a bunch of shit you hate, probably in cancer stuff, wars, Lockheed Martin, you're paying for all that stuff that you just would, if somebody was like, hey, I'm going to create a missile head and would you put some money in here and let me build it and then I'll pay you later, maybe? You'd be like, no, I'm not helping you do that. And not only that, and I'm making a case for leaving your money there and letting it sit, thinking that you're going to do a good thing. When you retire, I want to say when you're around, because they keep changing it, 72, 70 years old, 73, they're going to require you to take out, it's called like a maximum withdrawal. It's 4%, right? And let's be honest, if you're 70 something years old, odds are you're going to live another 25 years. If you take out 4% of your principal over 25 years, that is 100% of your principal. You have nothing left. But that is how that game is played. And oh, by the way, when you take that money out, it's going to hit you as it relates to earned income or ordinary income, and it's going to raise your tax bill, right? Because you're going to be getting more income. It's either you're going to pay taxes on it now, have less money, or you're going to pay taxes on it later. It's going to knock you into the next tax bracket. And with everything going on in the world right now, do you think that taxes could be higher? Possibly. Possibly. That says what? Real estate's probably better for you because if you take your money, let's say you have a retirement account, an IRA or 401k or a qualified one, and you move it over to a self-directed IRA, now it's not tied to the stock market, mutual funds, or anything like that, and you invest it in a piece of real estate. And that real estate pays you cash flow from now until, let's say you're 40 years old, pays you for another 65 years. You have all this cash flow that's been coming in. You've never touched your principal because it's in the real estate. And let's say during that time you start collecting off of it, you're getting the tax benefits because you also get the pass-through tax benefits of the real estate. And then when you hit 70 years old and you have these maximum withdrawals of 44%, you're now only taking the cash flow. You're not taking the actual principal, right? Because your money is coming from the real estate. Boom, and you're good. That's the difference. And then, oh, by the way, when you die, you get to kind of pass this real estate on to your family members. You never really have to do it. It becomes generational. You won't do that with your retirement account if you continue to play the retirement account game the way the game was set up for you, which the game is not set up for you to win. It's set up for Wall Street and the IRS for them to win, not you. That was not a product for the regular person. It's like 401k was an actual section in some type of IRS code, but it got beat to death over time, and now it's not applicable the way that people are living today. So, again, I had a whole hee haw about a retirement account. I don't even have one. But Bitcoin, that's the next one. Yes, that is the one thing right now that everybody's running to. But let me tell you, you're not really getting any yield out of the Bitcoin for cash yield. Cash yield, yes, you put money in it, but you have to exit it. You have to sell it to realize that gain. So, yes, you can have a ton of money in there. I'm sure my man's going to be on here soon. I saw it earlier, Michael Saylor. He's the man. But you shouldn't be buying Bitcoin. I have some Bitcoin, dude, and I hate looking at it because it goes up, comes down, goes up, comes down. It's good, but you need a reserve. Eventually, I will do something with Bitcoin with our real estate. I will. All right. I'm in Cardone Capital. I'm in one of the funds. I'm in one of the funds that they have. And I see what they're doing as it relates to creating this new product by tying Bitcoin to real estate as a stopper. Real estate comes in, buys the Bitcoin's laid over the top. Now you can exit the Bitcoin or you can exit the real estate. That's a beautiful new product, but most people cannot do that. So if you're thinking about just taking your money and buying Bitcoin because you're watching the craze, just like the stocks, it's going to go up and down. And you can't buy a big enough position in Bitcoin to really hit the target, especially if Bitcoin's at, I think it's probably at 106 or something ridiculous today. Um, I'm not gonna look it up, but it's probably around 100 to 106 because it's been ranging there, maybe 101, maybe it's went up. But eventually, just like a couple of months ago, it went down to 87 or 86. And a lot of people, oh, it went down. Oh, it's going up. Oh, it's going down. Dude, that's a terrible climax. You don't want the ups and downs, man, in your investments. You want to be able to base it out. So, is Bitcoin good? Yes. Could it compare to multifamily real estate? Absolutely not. You put your money in there, it continues to go up. It's slow, steady, it's heavy, but I'd rather that when you're thinking long term. You want to be able to go to your practice, go to your business, go to your job. And when you get home, you already know next month, income, all that stuff's going to be handled just like clockwork. With real estate, you do that. You don't have that with Bitcoin. Next, your own business. This one's argumentative for most people because they're like, oh, I could dump a bunch of money in my own company. Yes, you can, but you don't need two businesses. That is the one thing. Yes, I was went to talk to one of my dentists, one of but just my dentist. We were talking about that, and he was talking about needing to reinvest in equipment, employees, locations, handling things on his own. If he had, let's say he had a windfall of, let's say, $1 million in a year. One, he would have to plan for that because he has a business. He has a bunch of write-offs he's going to have to do. He's going to have to figure out how to save some of that money, shelter some of that money from taxes to not pay it. Um, if he has something left over, he could put money into marketing, but that doesn't mean he's going to hit the target of getting more leads in. Because if he gets more leads, what's going to happen? I think there's one, two, three, four people, maybe five that works there, some dental assistants, and him as a main dental person. Let's say he gets 200 more clients come in and he has to stagger them. He is going to be swamped. He's going to have to hire somebody else. And if he hires another dentist, they're going to cost just as much as him. Or if they don't, they probably have their own dental practice. Or he's going to have to sub stuff out. Or he's going to have to dual task somewhere else. Like it's going to become more work. Why bother? Just take that $1 million, pay your taxes, get as many write-offs as you can, and then do a tax strategy so you can roll that money into multifamily real estate. You plan a lot better. So if you have your own business, your own practice, you want to think about these things. Real estate is for me, in my mind, the number one place to be able to successfully I don't want to say save your money, but store money. Take your earned income, whether your business or your job or whatever it is that you do, and then you take that money and you reinvest that money into real estate and you get all the benefits of it. Number one thing you get capital preservation. You preserve your capital. Number one rule of investing, Warren Buffett 101, don't lose money. Number two rule of investments is don't forget rule number one, don't lose money. So you get capital preservation. Why? Because if you take your cash out of a bank, retirement account, savings account, money market account, wherever you have it at, sock, behind the wall in your house, some safe underneath your bed, and you move it into a real estate deal, that money doesn't go away. It's there. It could go away at the bank. It could go away at the stock market. It could go away in your retirement account. It could go away in Bitcoin. It could go away in your business. But if you rotate that money, you move that money and you invest it in a real estate deal, it's there. You know the money's there because the building is still there. The address is still there. The tenants are still there. Boom, you get it. All right. So next thing you get out of that is you get cash flow. Your cash flow is going to come in no matter what because people pay their rents on the first and people pay their bills somewhere between the first and the seventh, and then somewhere around the seventh to the 10th, distributions come. That's how those things work in real estate. The cash flow comes, especially when it's a passive income. I like to say passive income because it's passive to you. You're going to be running your own business, your own practice, going to work every day, taking care of your family, taking care of your health, taking care of your fitness, going to church, going to charities, doing the shit you do that you love. That money should just keep coming. Every time we've had a deal, man, my cash flow deals, they just come. They just come. They just come. All right. So the next thing that you're going to get is you should get appreciation in your deals, long-term appreciation. The rents in this country have doubled every 10 years, roughly. 10 to 20 years, they've doubled in this country, which means multifamily values have doubled every 10 years in this country. So if you think 10 years back, let's go 10 years back. Did you think the rents where you live at were going to be what they are today 10 years ago? Right? Let's go 20 years ago. Matter of fact, if you called your mom, if they're still alive, or your dad, or your grandparents, or your aunts and uncles, and you take a look at the neighborhood and you ask them, hey, what would have happened had you bought the whole block, the whole neighborhood where we lived at, and you kept it as a rental? One, the properties would be paid off. How rich do you think our family would have been? If you ask them that, they're all going to say the same shit. They're going to be like, man, we should have did it. We should have did it. I think about it now. I'm like, man, if my mom and dad would have bought everything where they live at, crushed it. If I would have bought everything and held everything so far in my career, I'd already have $1 billion worth of real estate. It would be ridiculous because I would still have it because the rents would have continued to grow. I never knew the rents were going to continue to grow the way that they did. All right. So that's the forced appreciation because, and I bring up the rents because rents control the values in multifamily real estate. In investment property, that's where the value comes from. Increase the rents, increase the value. And that way, that's how we make money for our investors. All right. Next thing, do you get the tax advantages? You get the tax advantages of real estate. Real estate as a investment vehicle has the best, it's almost like the tax codes written for them. The more real estate that you have, the larger the real estate you have, the better quality assets that you have, the better the tax advantages for you and your partners. If you're a real estate investor or you're a passive investor, those real estate, those taxes get passed on to you as an advantage, which allows you to offset your other income, right? The income that you get from the real estate, the passive income, you get the benefits of that. And depending on whether you want to classify yourself as a real estate professional or an investor, it's called something. It's a real estate professional, right? You have to do 750 hours a year, which is 15 hours a week spent on real estate. You got to get with your tax guy on that and register yourself as that. But you get the benefits of that also to be able to write off against other income. Anyways, do you get the tax advantages of being able to do those things? All right. So next, you get the scale. The scale meaning, let's say you as an individual, let's say you're a business owner, you have $1 million that you want to invest, 200,000 you want to invest, 300,000 you want to invest, whatever, right? You can take that 300,000 and let's say I'm raising $40 million. You can take 300,000 and be a part of the 40 million, and then you get the benefits of being an owner in that deal through the scale, right? Because now, if we're raising $30 million, we're going to buy a, let's just say, 90 or $100 million deal, $120 million deal, whatever. Um, yeah, yeah. Let's just use that number. You get the scale of that because on that specific deal, that may be 200, 300 units, whatever, depending on where you're at. Like you get the scale of not only having one unit, you get the scale of being involved with other investors inside of 200 units or 250 units, 225 units. That's the ability to scale your investments with others, right? To play this game that way. And then next, it's an inflation hedge, right? Because what I say earlier, because it's a real asset, which is the next one, because it's real, you have the opportunity to stay ahead of inflation, right? Since 1945, rents in this country have grown anywhere from 8 to 9%, in some markets higher. And they can slow down, they can get better, but that's on the average. That said, very few people talk about this. That 8 to 9% in rent increases in multifamily real estate across the board in this country has beat the S&P 500 over and over and over again based on the averages. Since 1945, since World War II, since your grandparents came back home from the war, started making babies, rents has continued to grow up in this country. That said, that continues to beat inflation. Right now, the feds are fighting to keep it at the below 3%. But on the average rents, for me, when I'm looking at a rent or I'm underwriting deals on rents, I'm looking at an average from 3 to 5% rent increases on the average per year. That can stop one year and it can be flat one year, up the next year, or one year it could be 10, 12. I think rents went up by anywhere from 12 to 15% in 2018, 17 through COVID. That's huge. Now, Some people are going to lose that stuff, but you got to know when you're doing an investment that this matters because the investment that you're in, if it's a real asset, you are going to continue to beat inflation because inflation actually gives real assets a lift if your money is tied to them. All right. And then last but not least, like we said, it's a real asset. It's real. It has an address, has somewhere to go. It's not an app. It's not like these things on my phone. Like if you look at my phone, all these things on my phone, those apps on my phone, they can all go away, right? The app for edits on Instagram, Pandora app, the app for CNBC, my boxing timer, all these apps, they're not real. If I go to you and I go, hey man, look, here's a real estate deal, right? Here's the address, take a look at it, drive by it. We're having a meeting. We're going to talk about how this deal is going to work. That is a real thing. That's not an app. That's not a made up thing. It's not going to disappear overnight. Matter of fact, we talk all the time about how like people get robbed because the schemes about people taking money. A lot of those things are not real assets that they're investing in. Because if they were real assets, they invested in them. Somebody could seize those assets, the courts could seize them, and then liquidate a real asset and get some of the money back. You can't do that if it just evaporates into thin air, right? That's huge. So that's another reason why I value multifamily real estate or real estate in general, income producing real estate, big institutional quality real estate with debt, with people, with partners. All of that stuff's a value to you guys, but you don't realize that unless you're really involved in playing this game, not this nightmare that I continue. See, now we need the nightmare. But I like to look at the nightmare. So when I'm awake and I'm looking at the stuff that I want from real estate perspective, it puts my real estate into perspective of what I also don't want to deal with. I don't want the ups and downs, neither do you. If you're working your job, your business, your practice, you're off doing great things for people, delivering a service and a product for people, you don't want the ups and downs in your investments. I know I don't. I don't want the chaos. So how do you overcome the chaos? You focus on the correction of chaos, which is some stability, which is real assets, real estate, like what we look at. So I hope this helps you guys. I wanted to go over that today, why I feel like real estate's better than some of these other opportunities based on what's happening in the world, and what are the benefits of real estate if we're going to be like, hey, why are they beneficial? Right. And I gave you 8 of them. Yeah, 9 of them. Oh, I forgot it. Hard to disrupt. That's number 9. It's hard to disrupt. You can't just take it away, which is why I said you can't just liquidate it. They're real, hard to disrupt, can't just go away. So I hope this helps you. Put it in the comments. What'd you learn? Or what'd you hate? Would you go, no, man, I'm in stocks and I just can't help myself because I'm a day trader? Good, go do that. I got buddies that crush it at that. But the reality of it is they day trade, and once they take that money out, they realize it. They got to pay tax on that money, and they spend all their money into real estate, all of them, because they need the tax write-offs. So that said, if you need me, you want my help for something, let me know. If you're a doctor, you're a physician, you're a professional, you're a small business owner, we are having a networking event. This is for people interested in being passive investors, not active. You're like, dude, I don't want to do my own stuff. I don't want to learn. I don't want to watch all your YouTube videos. I just want to see what the opportunity is to invest money, and I can focus on growing my business and my company so I can continue to create generational wealth for my family. And I want to do that with real estate. And for some reason, Victor, I like you. Go to bell-capital.com/RSVP. Put your name on the list. We'll reach out to you. I want to build one of the largest passive investor networks in Southern California with people who are serious about investing in real estate. They love the idea of cash flow, appreciation, tax advantages. They have great attitudes. They're serious about what they're doing, and they want to be a part of something that's growing and really just great people. I want to help you guys. All right, so I'm here for you. Let me know if you need anything. Go to bell-capital.com/RSVP to get added to the passive investor list. If you're not in California, you want to fly in, add your name to the list. We'll let you know what the next dates are. If you want to just skip all that and you want to see what we have available to you, go to bell-capital.com, hit get started or invest now or whatever it is. Register on our investor portal. You can take a look at our open fund, the deal, the docs, how to get involved. You can reach out to us. You can schedule a call with myself or somebody on my team. We are here to help you. And inside of the portal, if you're in there, we know you're a part of our network, our community for potential investors. I always share and show with you exactly what we're doing, why we do it, deals we're focused on, deals we let go of, things like that. So, but again, I appreciate you. Have a great day today. Let us know if you need anything. Again, bell-capital.com or bell-capital.com/RSVP if you want to join us at our networking event coming up here soon. And I will see you then. Let's get after it today. Boom.